What if I told you that millions of retirees are making retirement decisions based on rules that no longer exist? And some won't discover the mistake until it costs them thousands of dollars. That may sound dramatic, but it's true. Over the last several years, Congress and the IRS quietly changed some of the most important retirement rules affecting required minimum distributions, inherited IRAs, penalties, and retirement tax planning. Some of those changes created opportunities. Others created new risks. And many retirees either never heard about the changes or only heard part of the story. That's what makes this dangerous. Because retirement planning isn't just about what you know, it's about what changed while you weren't paying attention. Most retirees assume the biggest threats to retirement are obvious: a market crash, a recession, inflation, medical expenses. Those risks are real, but some of the most expensive retirement mistakes happen for a much simpler reason. People continue following yesterday's rules in a world that has already moved on. And by the time they realize something changed, some of their best options have already disappeared. Today, we're going to look at several retirement rule changes that most people either missed completely or don't fully understand. More importantly, we're going to talk about the consequences, because the rule itself is rarely the problem. The consequences are. Before we continue, if you're serious about protecting your retirement from hidden risks, costly mistakes, and consequences most people never see coming, please like and subscribe. That's exactly what Retirement Reality Check is all about. And the first rule change we're going to discuss sounds harmless. In fact, many retirees celebrated when it happened, but that's also why it catches people off guard. For decades, retirees understood a simple reality. Eventually, the government would require them to start withdrawing money from their retirement accounts. Those withdrawals are called required minimum distributions, or RMDs. The reasoning is straightforward. Traditional IRAs and similar retirement accounts receive tax advantages for years. Eventually, the government wants those taxes paid. For a long time, retirees expected RMDs to begin at age 70 and a half. Then the rules changed. The age moved to 72. Later, it changed again. Today, many retirees begin RMDs at age 73. And for some younger retirees, the age will eventually rise to 75. At first glance, this sounds like great news. More time before mandatory withdrawals, more years of tax-deferred growth, more flexibility. And in many situations, that's true. But here's the part many retirees miss. More flexibility doesn't automatically improve a retirement plan. It simply creates more choices. And choices only create value when they're used wisely. Imagine two retirees. Both retire with similar account balances. Both have similar spending habits. Both believe they're financially secure. The first retiree views retirement planning as an ongoing process. He periodically reviews his accounts, evaluates tax opportunities, and adjusts when circumstances change. The second retiree assumes retirement planning ended the day he left work. He rarely reviews his strategy because everything appears to be working. 5 years later, both retirees still seem successful. But beneath the surface, important differences have emerged. The first retiree may have taken advantage of years with lower taxable income. He may have positioned himself for smaller future withdrawals. He may have created more flexibility. The second retiree may have done nothing wrong, but doing nothing is not always the same thing as making the best decision. Because every additional year of tax-deferred growth can create a larger future account balance. A larger account balance can create larger required withdrawals. Larger withdrawals can create larger taxable income. And larger taxable income can trigger consequences many retirees never anticipate. For example, many retirees are surprised to discover that retirement income doesn't exist in isolation. The tax code doesn't care whether income comes from a paycheck or a retirement account. Income is income. And when withdrawals become large enough, they can push retirees into higher tax brackets, affect Medicare premiums, and reduce flexibility in future years. That's why delaying withdrawals isn't automatically good or bad. It depends entirely on how the opportunity is used. And that's the hidden lesson behind many IRS rule changes. The rule itself is rarely the biggest issue. The real issue is whether retirees recognize the opportunity the rule creates. But the IRS didn't just change when withdrawals begin, they also changed the consequences of making a mistake. And surprisingly, that created a different problem. Let's say a retiree forgets to take a required withdrawal, or calculates the amount incorrectly, or assumes someone else handled it. For years, this was one of the most feared mistakes in retirement planning because the penalty could be enormous. The penalty could reach 50% of the amount that should have been withdrawn. Think about that for a moment. If a retiree missed a required withdrawal of $20,000, the penalty alone could potentially reach $10,000. That's not a paperwork issue, that's a financial hit. And it's exactly the kind of mistake retirees want to avoid. Fortunately, the rules changed. The penalty was significantly reduced. And in some situations, it can be reduced even further if the mistake is corrected promptly. Most retirees hear that and think, great, one less thing to worry about. But that's not necessarily true because reduced penalties don't eliminate consequences. They simply reduce one of them. Taxes still apply. Corrections still need to be made. Documentation still matters. And confusion remains surprisingly common. In fact, one of the strange realities of human nature is that when a risk appears smaller, people often become less careful. They pay less attention. They assume someone else is handling it. They become comfortable. And comfort can create mistakes. That's one reason retirement problems often develop quietly. Most retirees don't wake up one morning and make a catastrophic decision. Instead, they make a series of small assumptions. They postpone a review, ignore a notice, delay a conversation, assume nothing has changed. Then years later, they discover that the consequences accumulated while they weren't looking. And nowhere is that more obvious than in the next rule change. Because this one doesn't just affect retirees, it affects their children. For years, inherited retirement accounts often benefited from what became known as the stretch IRA. Beneficiaries could frequently spread withdrawals over long periods of time. That allowed taxes to be recognized gradually. For many families, it became a valuable planning tool. Then the rules changed. Today, many inherited retirement accounts must be emptied within 10 years. At first glance, that may not sound like a major problem. After all, money is still being inherited. But that's not the real issue. The real issue is taxable income. Imagine your daughter is 55 years old. She's still working. She's earning a solid income, building her own retirement. Then she inherits a substantial IRA. Under older rules, Those withdrawals might have been spread over decades. Today, the timeline is often much shorter, and those withdrawals don't arrive in isolation. They're layered on top of existing income. Suddenly, decisions about timing become more important. Tax planning becomes more important. Future income projections become more important. The retirement account you spent decades building could create tax consequences your heirs never expected. This doesn't mean inherited IRAs are bad. It means the rules change. And when the rules change, old assumptions become dangerous. Many retirees spend years building wealth. Far fewer spend time thinking about how that wealth will eventually be transferred. That's understandable. Most people naturally focus on their own retirement first. But some of the most important consequences of today's decisions may not appear until the next generation inherits the assets. And that's why retirement planning is no longer a one-time event. It's an ongoing process. But there is another hidden consequence that affects even more retirees. One of the most dangerous phrases in retirement planning is, "I'll deal with it later." Not because retirees are careless, not because they're irresponsible, because life gets busy. Retirement is supposed to be the reward for decades of hard work. People travel, spend time with grandchildren, take care of aging parents, volunteer, pursue hobbies, enjoy the freedom they've spent their entire careers earning. Meanwhile, retirement accounts quietly move into the background. Statements continue arriving. Balances appear healthy. Nothing seems urgent. And that's exactly why opportunities are missed. Years pass. Then important decisions begin arriving all at once. Retirees suddenly find themselves dealing with questions about withdrawals, taxes, Medicare premiums, beneficiary designations, estate planning, and Roth conversion opportunities. What felt simple a few years earlier can quickly become much more complicated. Many retirees discover they have fewer options than they expected, not because the rules hurt them, because time reduced their flexibility. One of the most frustrating realities in retirement planning is realizing that many of the best opportunities exist before you actually need them. Consider the years between retirement and the start of required minimum distributions. For many retirees, that period creates a unique planning window. Income may be lower than it was during working years. Tax opportunities may be available. Future withdrawals may still be manageable. And retirees often have more control than they realize. But many people don't recognize the opportunity while it's available. They assume there will always be more time. Then later arrives. RMDs begin. Taxable income increases. Medicare premium thresholds become a concern. And some of the flexibility they once had begins to disappear. The pattern repeats itself throughout retirement planning. Estate plans need updating. Beneficiary designations need reviewing. Tax strategies need adjustment. Opportunities that once existed can quietly disappear if they aren't acted on in time. One of the hidden truths of retirement planning is that options have value. The ability to choose when income is recognized has value. The ability to decide whether assets should be converted has value. The ability to manage future tax exposure has value. The ability to adapt has value. Many recent retirement rule changes actually provide more flexibility than retirees had before. But flexibility only creates value when someone uses it. The biggest lesson isn't about RMDs or inherited IRAs or penalties. The biggest lesson is much larger than that. When most people think about retirement threats, they imagine dramatic events: stock market crashes, recessions, inflation, economic turmoil. Those risks are real and they deserve attention. But many retirement problems arrive much more quietly. A rule changes and nobody notices. A deadline shifts. A withdrawal strategy that once made sense gradually becomes outdated. A tax-saving opportunity passes by unused. A beneficiary designation remains unchanged for years, even though family circumstances have changed. None of these events feel urgent when they happen. Most never receive major media attention. They don't dominate headlines. They don't create panic. Yet over time, they can have enormous consequences. That's one of the biggest retirement realities people rarely discuss. Many retirement setbacks don't come from a single catastrophic event. They come from a series of small decisions, missed opportunities, and outdated assumptions that quietly compound over time. And the damage develops gradually. Many retirees don't recognize the problem until much of their flexibility has already disappeared. Think about how often retirement planning is described. Most discussions focus on investment returns, withdrawal rates, asset allocation, market forecasts. Those things matter, but successful retirement is often less about predicting the future and more about remaining adaptable when the future changes. The retirees who thrive are often not the ones who predict every market move. They're the ones who stay informed, review their plans, ask questions, make adjustments when necessary, and avoid becoming trapped by assumptions that used to be true. Because retirement isn't static, it's constantly evolving. The tax code evolves, government rules evolve, family circumstances evolve, health evolves, financial priorities evolve, and retirees who stop paying attention often discover the consequences too late. That's why Retirement Reality Check exists, not to create fear, not to overwhelm people with technical information, but to help retirees recognize risks before those risks become consequences. And that brings us to the most important takeaway from today's discussion. The IRS changed several important retirement rules. Some changes created opportunities, some reduced penalties, some altered withdrawal timings, some changed inheritance planning. But the biggest mistake retirees can make is assuming retirement rules remain frozen forever, because they don't. And retirees who continue operating under yesterday's assumptions may eventually discover consequences they never anticipated. The good news is that most of these risks are avoidable, not through complicated strategies, not through constant worry, but through periodic review and thoughtful planning. The retirees who put themselves in the strongest position are rarely the ones who know every rule. They're the ones who remain flexible when the rules change, because retirement planning isn't about perfection. It's about adaptation. And the earlier you recognize that, the more options you're likely to have when important decisions arrive. I'd love to hear from you. Which one of these retirement rule changes surprised you the most? Did you already know about the changes to RMDs, inherited IRAs, or retirement penalties? Or was there something today that caught you completely off guard? Let me know in the comments below. And if you're serious about protecting your retirement from hidden risks, hidden consequences, and costly mistakes, make sure you subscribe, because that's exactly what we do here at Retirement Reality Check. We don't simply discuss retirement concepts, we focus on retirement consequences. And in our next video, we're going to talk about a risk that can damage even a well-designed retirement plan. A risk that has nothing to do with spending too much, nothing to do with making obvious mistakes, and nothing to do with bad planning. Sometimes all it takes is one bad year, and that's where things get dangerous.